paying down debt is saving.
I'm getting older. Is it too late for me to start?
You have to be very careful not to, what I call, play someone else's game.
Here's the thing. Starting to invest can feel like everyone else already knows the rules, and you're just trying to make sense of it all. Welcome back to In My Finance Era. I'm Allie. This is a podcast where we take the real-life money questions you've been asking and help you turn them into clear, actionable next steps. Today, we're breaking down investing, how to start, what actually matters, and how to make sense of all the information coming your way. I'm joined by creator Mikey Kaloka and head of global advice methodology at Vanguard, Joel Dixon. Appreciate you both being here.
Thank you. Thank you.
Great being here.
Mikey, you connect with more and more people every day talking about your financial investing journey. You're super passionate about it. Why did you become passionate about it? And tell us a little bit about how you got started.
I think just like everybody else, I was petrified when I first started. I mean, I think I started investing when I was like 16, maybe. I bought like one stock out of just thinking that, I use this product, I should probably invest in it. I think I ended up selling it the minute it went down like 2 cents. So I think just like everybody else, I was very scared, but it's just something that I've always known that is there. I know it's good for me, so I should be doing it. So that's kind of like how I began it, and then it's just kind of taken off today.
Yeah, and you are not alone. I think a lot of people are concerned on how to get started, what it all means, which is why we are so glad we have you here, Joel, today. Investing guru on podcasts, media, webcasts, everything. You are the perfect person to talk about this. Thank you so much for being here today.
Well, it's great being here, Allie. Really appreciate it. Actually, Mikey, your story about getting started, it's so common. The way I ended up getting started years ago was I got the gift of a share of a gold-related company.
Now you're doing great.
Yeah, well, except that was back when gold was the meme stock of the late 1970s and so forth. It's like, what are the mistakes you make along the way? What do you wish you would have known at the time?
Yeah.
But the benefit of doing that young is that you have all of your future investing to kind of make it up, if you will.
That time, yep.
Totally. And Joel, you wrote the Principles for Investing Success. We need to start there. And we actually found in a recent Vanguard survey that a majority of 18 to 34-year-olds don't see themselves as investors. 64% say they don't have enough money. 69% say they don't know enough. 59% don't know where to begin. And 72% are afraid of losses. Tell us everything. What are the principles for investing success?
My, that added up to more than 100%, didn't it? So we've got a lot of work to do. I guess what I would say is, I think the most important thing is what we call goals. Know what you're saving for and why. What's the purpose that you have for that savings and the investing? Then beyond that, it's like, we talk about things like balance. What does the diversification or your mix of investments look like to be able to help attain your goals over time? Worrying about costs along the way is kind of that third pillar. And costs mean not just the cost of the investment, but things like taxes, other things that get in the way of you being able to spend the money in the way that you most think about. And then finally, we talk about discipline. And discipline just basically means, hey, stick to your plan. Unless something has happened that changes, this life event or, something overall in terms of your goals and approach, stick to your plan. There are going to be bumps along the way. But having that plan, having that goal in mind can just make it a lot easier to figure out what to do, or more importantly, sometimes what not to do.
Yeah. And Mikey, you talked about kind of your plan and how it's changed when you first started feeling unsure. Does any of that resonate with you? And how have you changed your plan over time?
Well, kind of like what he said, kind of like the whole the bumps in the road. I kind of think of it like waves in an ocean. There's a phrase that I've learned as I'm adulting now, dollar cost averaging, which is just buying regardless of what the heck is happening in my life. So like discipline, just like consistency for me. Every time that I get paid, I know this is coming out. I know that I'm investing, no questions asked. If I don't do it, I feel wrong. So that's kind of like what for me is kind of kept me going in my whole journey is just before I was scared. I'm still scared, but I'm just doing it every single time that I get paid.
Mikey, you mentioned dollar cost averaging. Joel, can you tell us what that is? And maybe even a couple steps back, can you talk to us a little bit about the differences in the basics between the stocks, bonds, asset classes? What does this all mean?
Sure. So dollar cost averaging is actually a quite powerful way to just have regular investments, get it in, get it saved, get it invested. Putting the same amount in every month or every couple of weeks. Mikey, you were talking about it as when you got paid, and just making sure having that regular. Automating that kind of piece is just so important because you may not do it if you don't automate it. And inertia is a very powerful force. And so use inertia for good and have the regular investment. When we talk about, though, the types of investments and so forth, generally we start thinking about things like, you'll often hear about stocks, bonds, cash. And what are each of those in some ways? Cash, you think about it as, what might be held at a bank or in something where I can kind of demand it back very quickly. I have like full liquidity to get that money back. A bond is you're lending somebody money. Much like if you have a mortgage or a student loan or something, you've been lent money and you're paying back interest and some amount of principal over time. A bond is just where you are lending somebody else money, and so they're paying you interest over some period of time. And then a stock or equity is a share of ownership in a company. So after everyone else gets paid, if there are profits left in that company, then you as an owner get to enjoy that. Each of those cash, bond, stocks have different levels of risk, if you will, right? So stock is, hey, look, if there's money left over, that's great. But if there isn't profit, you're not getting anything as an owner. So, you kind of expect, although certainly not guaranteed, that you might get a bit of a higher return because you're taking on more risk than, say, a bond or than cash. And so you think about this in terms of what we would call risk return characteristics. The more risk that you take in kind of these asset groups and types, the more you would expect to earn over time without it be guaranteed, because you also comes with it more what we would call volatility. Yeah, it might be up 10%, it might be down 10%, whereas cash probably isn't moving as much. So when we talk about investments overall, diversifying, kind of getting exposure to each of those groups of assets in ways that make sense for your goals, for your time horizon, and so forth.
Such a helpful breakdown. Thank you for that. Let's dig in a little bit further on, we talked a little bit about the principles of investing success. What about getting started? So if someone has $100 a month to invest, what should they do? What should they think about and where should they start?
So if they have $100 of money to invest, I actually think they've already started, because in many ways, the best way to meet your goals over time, and the most important thing, is not the investment returns that you get on the dollars, but how many dollars you put to work to generate investment returns. It's that saving piece of it. And I'll give you a quick stat, and this is, kind of as we talk about a lot of times. If you're thinking about saving regularly and you have a goal that is, let's say, 10 years from now, in kind of just a regular, balanced, normal type of investment approach, that balance that you have at the end of 10 years to fund whatever it is, some great trip, or maybe it's, paying off some student loans or whatever it might be, 80% of that final balance will have come not from the investment returns, but from the contributions or the savings that you made along the way.
Wow.
So, if it's $10,000 at the end of the 10 years, most likely $8,000, give or take, was from the contributions you made yourself. And $2,000 was from the actual returns on that investment. So that relative importance of saving is just tremendous and huge, especially if it's in the context of a shorter investment horizon. Mikey, you made the point about, just dollar cost average and discipline and doing it. And that is the best way to get started and then to make those investments work over time.
Yeah. And we've talked a lot about people. I love the point that you made about $100. Like, you already are doing it. I ran a marathon a couple years ago. And before that, everyone was like talking to me, runner friends who just getting started. They're like, I can only run a mile. How are you running a marathon? I'll never be a real runner. And I'm like, going on a 2-minute run, you're a runner, you're in the game. It's the same example that you gave. You're in it. Like, if you're thinking about it, if you're feeling it, if you're getting started, if you're imagining your journey, you're in it.
Even creating content, same thing. Mm-hmm. I mean, even like people look at me now, and I'm not some gigantic creator, but I've reached a platform where people will look at me and say, "How the heck did you do that?" Yeah. It's funny because right now, if you ask somebody, "Do you want to be a content creator? Do you want to start investing?" "Oh, it's too late. I could have done it 3 years ago, and I would have been in a way better position." That was the same answer when I started making content. I could have started investing years ago or making content years ago. So it's the same thing. It's never too late. You just got to start. $10, $50, $100. It doesn't really matter. You just got to start.
Yep. We've talked about the principles. We've talked about what to do when you're getting started. What about when there's a ton of conflicting information? We see information on finances and investing coming from everywhere. How do we kind of parse through it all? How do we make sense of it all? And what should we be thinking about?
Actually, I want to get Mikey's take on this first, which is, there is so much out there, on you should invest this way, you should use this strategy, you should take this approach, this is the way to investment riches, and so forth. How did you go about and sorting through all of that?
I think for me, it's learning online, obviously like being mindful, being like wanting to be educated, being curious, but also just like dipping my toes in the water.
Yeah, and that's what I would love to highlight, because I think so much of the noise that's out there in the system is really somebody is trying to sell something. They'll talk about their great investment success. They won't let you know what didn't work for them. So you're hearing a very one-sided kind of view.
Yes.
You're getting the highlights. Like, I will tell you exactly which of my stocks did really well. I'm not going to tell you the couple of dozen that didn't, right?
Yeah.
And so you have to be very careful not to, what I call, play someone else's game. And they're kind of like long-term, what we would say, good investing, approaches and principles. A diversified portfolio of stocks, bonds, and cash that matches your, ability and willingness to take risk and your, time horizon that you have for your goals, and focusing not so much on the individual, lottery ticket. I often call it. A lot of what people talk about are, in effect, some version of a lottery ticket.
Yep.
Hey, if you do this, look at this, that might happen. Steady, consistent investment strategy applied over time. It may be boring, but boring in this case is often more successful.
I think it's unique too. Like, I think people need to understand, and you said something a second ago, people need to understand that you cannot follow somebody else's footsteps and expect the exact same return. Because if you're investing in what somebody is telling you to invest in, you're investing later than they did. Yeah. So they're going to see a different return than you did. Yeah. So same thing with like my portfolio. I might invest in something that you guys might hate, but I believe in it. And I'm going to put double down on it. So I think everyone is just unique. And I think goes for a lot of things, and just life in general is just, we can't really copy each other because it's not always going to be the same result.
Well, you talk about this kind of personalization, everyone having kind of their own state that they're in and where they want to go and their different goals and journey that they're on, and making it really your own. You are a gig worker now, so to say. So you're pulling an income from different places. How does that affect your investing journey and your plan? And when you started to pull income in from different spots, did you have to reevaluate your investment strategy?
Well, pulling in income from different spots is very like, I'm actually still getting used to this as I speak. I think I'm just now still learning, like, to see income coming in from different places. When it lands in my bank, like what I do with it, I still think that my answer still remains true. I need to be investing. If I'm not, I'm doing something wrong. Like I said, I'm still learning. I've gone from a W-2 job to making one income to now making like 5 or 6, 7 different streams of income. So now I'm learning, like, oh my gosh, when this money comes in, how much do I invest? And I'm actually personally speaking to a financial advisor to figure out, like, what do I diversify? What do I do? I might need to talk to you a little bit and I'll figure this out. But yeah, it's something that I'm learning. I'm not afraid to share that I'm still learning, but it's a work in progress.
Yeah. And that personalization piece, something else that comes with that is the differences that people are able to take on when it comes to risk. We actually saw in our recent survey that about 27% of 18 to 34-year-olds say they are unwilling to take any financial risk. Joel, can you unpack a little bit on that risk piece and what it means for a new investor and what they should be thinking about and how they can make it personal to their journey?
So I'll start with, if you're unafraid to take any financial risk, you're actually taking financial risk. And what I mean by that is, let's say, okay, I don't want any variability in the investments that I see. Well, most likely then you're not going to probably keep up with inflation over time on the underlying investments. So you're actually taking a different form of risk, which is that the $100 that you were going to invest today, you could otherwise consume, buy goods or go on a trip, whatever. If you don't get a return that's above inflation, that $100 today actually buys less in the future than it does now. And so if you're like, oh, I'm going to invest, but I'm not going to take any financial risk, you really run the risk of not being able to meet your goals in the same way that maybe you could today. So I'd start there. The other thing is, I think in many ways, the most important organ, if you will, in the body to deal with investing is not the brain, it's the stomach. And so, when you think about risk, can you sleep at night? Are you worried about your future and so forth? If, you're finding that, boy, the market is down, whatever, X%. And it's like, boy, I'm not sure I'm going to be able to meet my goals and so forth. It's like, well, then maybe that's an indication that you maybe need to take a little bit less risk, all else equal. But remember, stick to the discipline part of that investing success that we talked about earlier, which is like, has your goals changed? Has your strategy changed? Has how much you're investing on a regular basis changed? If nothing has changed in your financial plan or your goals or your outlook, your time horizon, you probably don't need to change in the kind of wake of the noise that might be right in the moment.
You mentioned a little bit about that balance and making sure you're having fun. In our recent survey that we ran, we found 31% of 18 to 34-year-olds see investing as a form of entertainment, excitement, fun, or playing a game. So there is fun in this after all.
There can be. Just don't confuse investment with, being able to meet your bills and your goals and objectives. Don't put the rent money at risk.
Yeah, definitely not.
Yeah, I feel like we're seeing this like literally everywhere now. Like everywhere we look, I feel like it's sports gambling because now the legalization of it kind of in different states. But now we're also seeing the prediction markets too. It's kind of everywhere. And then what's really crazy is that people are using their bill money to pay for it, which is really like that part is insane to me.
It's such a fine line or balance. We talk about balance and, how do you think about, what can often be, what we're often told about how to be a successful investor and, how, regular diligent saving and, put it in a kind of diversified portfolio where you don't have anything really to brag about or to hide that maybe has done poorly.
You know what's funny, really quick?
Yeah.
You're saying this, and I'm almost seeing like two perspectives because I feel like for some people it's the understanding part too.
Yeah.
Because right now you just said diversified portfolio and
what does that mean?
What is that?
It just like for some people that seems like French, but then to some people betting on sports or like gambling to them makes more sense because it's comprehensible for them.
Yeah.
So I think it also comes down to what we started with is just like becoming more curious and wanting to learn more about it. Because of like, again, it makes you happy.
Absolutely. Yeah. The be curious piece, learn kind of what you feel you need to know and understand is in many ways a great approach. It is very much that, sometimes some of these things can just sound like from people like me about eating your vegetables, right? It's just sort of like, kind of just be diligent, do it all the time, regular, eat the vegetable. Fact of the matter is, if you're not going to have some sort of fun or understand how this meets your goals over the long term,
exactly,
you're not going to do it.
Yeah, you got to have a cheesesteak with the vegetables, man.
Yeah, cheat days are fine.
Yes.
I'm big in cheat days.
Yeah.
And if that's going to be what allows you to be successful in terms of your goals,
it's balance.
Have that cheat day.
Yeah, it's balance, 100%.
But don't put the rent money at risk.
100%.
We've covered a ton of information. We've got a few minutes left. Mikey, any final questions that you want to ask Joel?
I do. I would love to ask you one question. Yeah. Obviously, I have a very wide range of an audience, but I do have a pretty large audience. It's a bit older, 30s, 40s, 50s, that they think it's
That's
a little
young,
too
by the
late.
way. Just saying.
Whoa, wait. I knew this was going to happen, bro. But 30s, because they always tell me I'm getting older. Is it too late for me to start? Because like obviously you hear 18, the sooner you start, the better, right? But 30s, 40s, is it too late for that person to start? Is there something else they could be doing, should be doing? Or is investing still the best move?
It is never too late to start. And oftentimes we hear that in different ways, which is just sort of like, oh, I haven't gotten started. And so now I have to do something different where it's like, well, I just am where I am. I'm not going to start now. I've got this lifestyle that I want. Or the people will be like, tell me something that's going to get me a really high return in a short period of time so that I can make up for it, which is extraordinarily difficult. The other thing I'm providing a little bit perspective on this. in many ways, I think people have started in ways that they don't think they have started. Paying down debt is saving.
Oh, yeah.
Right?
Yeah.
And so, if you're talking about saving for your future, paying down that debt, which people might be doing, saying, oh, I don't have a lot of assets, but I've paid or I'm working on paying down a lot of debt.
Yeah.
That can be a huge financial overhang on people's future.
Oh, 100%.
And so just getting started in any way that trades off kind of what you're doing today with your needs, your wants, your desires of your future self. And in many ways, I think about it as, take a look in the mirror in the morning. Imagine yourself 20, 30, 40 years older. It's like, what do I want to do now to set myself up a little bit better in the future? And that may mean a little bit more savings now.
Right. What you just said.
Yeah.
I think about this a lot, actually. I'm not joking. Like every time that I get paid or I do something, I think of like myself 30 years from now. And I'm like, am I like upset that I'm doing this, or am I actually smiling at the fact that I'm doing this? So like either putting money in the stock market or like buying something at the grocery store that I probably shouldn't just because I'm hungry. Like, am I looking back at myself being like, Mikey, what are you doing? Or am I like, you know what, Mikey, good job. So like that little future, we talked about this actually the other day, but just like the future version of yourself, just like looking back and being like, good stuff, man.
Such great points. Thank you both so much for being here. Such phenomenal information for our audience. Really great things we can take away. Appreciate your time today and all your expertise.
Thank you so much.
Thank you.
Investing can feel complex at first, but hopefully today helped clarify where to begin and how to make sense of the information you're seeing. If you have questions or want to share what stood out, you can connect with us on social media. Send us a message there. You can also visit inmyfinanceera.com for additional resources to help you take your next best step. Thanks so much for listening.